Yeah, what's up? Yeah, we're doing yeah, we changed it up a bit. Honestly, the biggest thing I like about this is everybody seems way more motivated. Like when we had the free section, it was killing me like keeping up with a bunch of different people who just were not motivated to trade, not even willing to learn, like put in the effort. So that's probably the biggest thing like take away from that. I know Sven loves it too cuz Sven's super active in it. But yeah, we've been trying like different marketing types. We're gonna make a pivot back to socials because we were taking a little break from socials to focus on other things. Like we have an email marketing campaign that we set up through our website and stuff like that. But yeah, I'll go over this. Yeah, so they can opt in for the free strategy, and then it kind of puts them into that email marketing campaign, collects the data that way. I figured what I can do because I know you even talked to me before. Esteban DM me this week about his portfolio, and I know you've asked kind of about portfolio composition and stuff. So I can probably go through. Yeah. Well, I think for the most part, based on like my advice, mostly like I have obviously picked Esteban's brain a little bit this week about it, but mostly for me, my recommendation is going to be ETFs, just for the simplicity of it. And then, so I have two portfolios. I have my IRA, and then I have my individual account. I do have a third one, I guess, too, but that one's mostly for in the money market. Which, for those of you that don't know, the money market right now is at about 4.9 something percent, which is honestly a fantastic return. So my emergency fund that I typically keep in my bank, collecting like 0.01% interest. I moved it over to a money market with Fidelity. Actually, let me see here if I can. Let me pull up my portfolio, and then let's see. What is the ticker symbol? Oh, that's what it is. SPAX. Yeah, so this is um, government money market fund here in the States, at least with Fidelity that I use. And right now, where we at? Year to date, looking for, well, you can see 7 day yield, which is basically closer than what we're going to get, but about 5% on my money, which honestly is really, really worth it in a money market because it's backed by the US Treasury. So you can actually kind of see US Treasury bills, coupons, strips, all fancy words for just investment vehicles that are backed by the government. So I hate to say 100% guaranteed, but it's one of the safest investment options you can make. So that is where I keep my emergency fund at the moment. Um, I'm actually curious right at this moment because I'm not sure. Yeah, 2.89 it looks like right now. So, but it beats out my bank because my bank's inflation or interest right now I think is 0.01. Um, well, it's usually, it's typical for a lot of banks in the States. At least I'm not sure how it works in other countries, but yeah, that type of interest rate is just you're gaining almost nothing. So what I talked about with Esteban a little bit was VOO, and they don't have it here. Let's see. Yeah, I want to see if they have just your Vanguard S&P. I wish I had a better program here to go through it though. I let's see. This doesn't really give me too much. Yeah, I think VOO is a fantastic baseline, mostly because ETFs. It kind of depends on the. Hold on, make sure I wasn't missing any questions or anything. Yeah, mostly based on the tax advantages of ETFs over. So yeah, year to date 18.26, which is fantastic. Um, but the tax advantages of ETFs over mutual funds. So my Roth IRA that I actually showed. Let's see here. Search my messages. Where am I at? Hopefully I don't leak anything. It's sent admin channel. Let's go up here. So this is kind of my layout for my IRA at the moment. So I actually did make a change to this. I was on a call with a financial advisor yesterday, maybe the day before, and I decided that from a growth potential, I actually removed. I wish I had my weights in here. I don't. I had about there actually. Where am I at with go? Okay, so FSPGX, which is my highest performing fund, I had about 35% of my IRA in there, which is a large cap growth index. And then I had the large cap value index, which honestly, I completely removed this. So because all of these, when you see 5 letters, it's typically a mutual fund. That's what that means. When you see 3 to 4 letters, that's what an ETF is. So VOO, VOO, VGI, VGT, all of those are ETFs, but when you see 5 letters, it's more often than not a mutual fund, which means you do have to pay this expense ratio on a mutual fund because it's actively managed. But the other advantage to this is because it's in my IRA, there's no tax basis. So this is pre-tax, or sorry, post-tax money that's being put into this account, which means that mutual funds are typically not great for a tax advantage because the person who runs the fund is constantly having to sell off portions, buy into other portions or other whatever, they manage it actively, so they have to buy and sell a lot in there, and every time they do that it triggers a taxable event for everybody that's involved in the fund. But because I do it within my Roth IRA and I have mutual funds, it's essentially all managed for me without having to worry about that tax efficiency compared to my individual account, which I definitely had to focus a lot more into ETFs because it's a lot more tax. It's a much greater tax advantage that way. But what I actually did is I removed the large cap value and I actually replaced that straight up with the Fidelity 500 because this is probably one of my favorite funds of all time. Just because the expense ratio is the lowest in the entire industry, it beats VOO. Um, it beats every single index fund that tracks the S&P 500 or ETF. Um, the only reason I don't necessarily recommend it for people with an individual portfolio or a personal investing portfolio is just because of that. Like I said, the tax advantages um, of having an ETF are greater, so you actually end up saving more using VOO with time comparative to the expense ratio. But I basically just did a full what's called an exchange because they're both with Fidelity. You can actually just straight one-to-one exchange without triggering a taxable event. Obviously, it's an IRA anyway, so it's not taxable regardless. But even with an individual account, if you had mutual funds, you could just do a one-to-one exchange like that. And then I actually got rid of my mid and small cap indexes for something a lot more aggressive. So these are not very aggressive funds. I had 12 percent in change. So I had 8% in mid cap, 4% in small cap. I actually exchanged both of those for what's called a semiconductor. Um, it's a fund just based on it's a fund in the tech industry. It's actually performed fantastic. If I can pull up advanced chart here. So yeah, so this one here, destroying the S&P 500 benchmark over the long term. You can actually see the comparison here. If I zoom in a little bit more. So the S&P 500 is the blue line, and then the red line is just the industry, the tech niche in the stock market in general. And then you have this ticker that I'm looking at here. So the reason I did this was honestly just the aggression. It's obviously much higher risk, but overall the aggression and the performance over the last 10 years or 5 years has destroyed the S&P 500, obviously because the tech industry has been significantly growing faster. So that is what I did. I actually swapped out these two for that after talking to the advisor, and then I'm thinking of slightly taking some weight out of my global option here because I did have 22% weighting into global, which I think is a bit much. Global or international stocks, it's good to have that to hedge against the U.S. economy, but overall, like they grow much slower historically, so I don't know if it's a good I don't think it's a good idea to have 22% in there. It mostly just happens to do with the weight of as the US was entering recession, you'll see these other economies start to expand. And the value ended up creeping up from the 15% that I originally had. So I'll have to rebalance that most likely going to put it back into either the Fidelity 500 or even the large cap growth, which I do have a heavy amount of the portfolio in anyways, so I don't want to go too heavy with that at the moment. And then my individual portfolio, like I talked about, VOO is a great option. Let me just open a new browser here. Go 10-year Performac. There we go. Is there? All right, Yahoo. Yahoo's decent too. So you can kind of see VOO over the 10 years, about 13.11%. Another one I like is VGT. Where's Yahoo? So VGT over the 10 years, you're looking at about 20%, but this is mostly because it tracks the tech index. And as I talked about already, the tech sector is growing pretty significantly at the moment. I kind of do expect it to slow down a little bit within the next 5 to 10 years. But that's obviously speculation. I'm just going off of past data at the moment. And then VTI is another great one. So, oops, go to Yahoo. So yeah, VTI is just the total market index. You can see over the 10 years about 12% gain as well, which is still fantastic gain. So I think like for a basic portfolio, having these three is great. And then because most people here are a little bit younger, we get guys like Big Mac who still got to get old enough to invest. Where am I? Right here. We'll go with QQQ, which I think is another fantastic option. Because this one is definitely a lot more aggressive. So you can see 18%, 20% over the 5-year. It's more aggressive because it tracks NAS 100, which is instead of the top 500 stocks like the S&P 500 or VU, it tracks the top 100, so a lot more aggressive. But I think that's honestly really valuable to younger people, especially to try and I guess get the most growth you can at a younger age, and then be able to put that back into whatever the hell you want as you get older. So that's kind of my recommendation. If you wanted to create like a base portfolio, you could have these 4 funds in there. If you wanted to take a little bit more of a dividend focus, I would recommend something like SCHD, which is it's more of a dividend growth ETF. So your dividend isn't going to be that great. I don't use Yahoo Finance, so I have no idea how to see the yield, but historically it's typically, yeah, here it is, 3.43%. I was going to say 3, so it's a little higher than I thought it was, but still not the greatest dividend yield. There's plenty of funds that have a greater yield, but I do think from a growth perspective, it helps track the market fairly well. It's choosing great growth stocks and larger companies, so you're going to keep up with the growth side of the portfolio. You're not going to be sacrificing that for a high dividend yield, which is fairly common with a lot of dividend ETFs. They'll give up the growth for the chance of the higher yield. But let's see, actually, I don't even know if it's gonna, wonder if it's even gonna come up here on Yahoo. VUAA, not sure. Let's see here. Oh, so is this the accumulated ETF, which essentially just means you're reinvesting the dividend, correct? Or wait, gotcha. Yeah, so on my brokerage, there's an option where I can just kind of choose to direct my dividends, but yeah, for honestly, this is technically the better option than VU, but in the majority of brokerages, you can actually just take your dividend and there's an option in there to reinvest it, which essentially would make it the same fund as this. As far as I know, I don't know much about this specific fund, but yeah, yeah, all time was looking like 2019 into 2019. But overall, what this is going to basically do is track the S&P 500, but it's going to take your dividends and just reinvest them back into it, which honestly is so important. Like if you guys take anything away from my webinar today, reinvest your dividends back into the security or ETF that they're in. If you can reinvest your dividends back into VU, the growth potential that you're missing out on. So for example, like I know you guys have heard the math done all the time. If you put $100 a day, blah blah blah, 60 years, it'll be 5 million, whatever. You guys have heard that math, but 75% of that growth actually comes from the reinvested dividends, which is enormous to understand. Like, really let that sink in. I'm not going to go and do the math at the moment, but let's say you put $100 a day for the next X 40 years, 30 years, or whatever, and it turns into 2 million. Sorry, not $100 a day, $100 a month, and it turns into, say, 2 million. 75% of that growth, meaning what, 1.5 out of that 2 million, is solely from the reinvested dividends compounding in the account. So it is huge, huge, huge to understand that you need to turn those reinvesting dividends on for that long-term growth, or you're going to be pretty upset as retirement comes around when you realize it's not that 2 million that your investment calculator told you. um, Especially when it comes to outpacing inflation. But there was one more. Oh, the SPYI. So this is a fairly new fund, so not much data on it. But essentially, what their goal here is to have the highest dividend yield using contract plays against SPY. So it's definitely a bit riskier. Like, if you were to do something like this, the goal is to collect the dividend, but keep it a small portion of your portfolio. Um, and the reason being is because obviously you can see the growth tracks fairly well to the S&P 500. Or actually, let's just look at VU. So in the 1 year, 22%, it's just below that. Still pretty significantly below that, I would say at 12%, but the goal here is this yield. So compared to one of the leading dividend ETFs in the industry that has a 3.43% yield, with SPYI, because they're using covered calls against that the S&P 500, they actually have one of the highest the highest yields in the industry. So you're looking at about 1% a month. So if you are looking for some form of passive income, this could be a great idea to do so. But keep in mind, it's definitely higher risk than everything else that I showed up here, because it does use that covered call option. And it is a newer fund. It's actively managed. What is the expense ratio here? I don't know if they have it on Yahoo. It does not look like it. So that's just something to keep in mind as well for those looking for more dividend focused portfolios. I personally don't think at a younger age dividends are that necessary. I feel like you do want to kind of focus more towards that growth potential, and then down the line you can obviously reallocate funds towards dividends if you'd like. But yeah, that's just like my general breakdown, because I know I've talked to a couple of you about portfolios, how I would start them. Uh, and honestly, I think these four, if you look at VOO, uh, VGT, VTI, and QQQ, you're already going to have a significant foundation. How you want to allocate that is up to you. If I could also recommend, I would say maybe 20% into QQQ. And that leaves 80% to kind of play around with these three if you want. Just because QQQ is slightly more aggressive than the other three that I mentioned. Um, 15 to 20% should be more than fine in that, and then you can kind of reallocate the remaining to these three, and then down the line you can build on that portfolio if you'd like. But this already is a significantly strong one, and it's honestly a great start. So that would be my personal start when it comes to ETF investing. And honestly, the advantage of it is it's like a set and forget. You buy into these funds. Let's say you had a 25% split or allocation to each. You can even set up on most brokerages, I don't know about all, but most brokerages, automatic investments. And every month it'll take, say, 500 out of your bank account, and then it'll automatically divvy up that 125 a piece out of that 500 and just put them automatically into the four options that I just mentioned, which I think is a huge, huge advantage. So it's kind of like, you have the pie of all your portfolio here, and then it automatically takes the amount that you're investing and splits it accordingly based on your asset allocation, which I think is a huge, huge advantage, having that completely done passively. Because, as much as people think they're keeping up with their portfolios, a month or two might go by where you spend a little extra and you end up with less money, you don't end up investing it, and just kind of keeps you a little more disciplined to your investments compared to your spending. But yeah, we'll take a look at some of my trades I'm looking at the moment. I only actually have two. I haven't really gone through my pairs for next week yet, so I can maybe go do that. I'm in GBP AUD. Looks like we're nearly break even at the moment. I know some people talked about this one not closing above the high for them. I actually use the same. So forex.com is my brokerage that I use MT4 on. So I actually just use the data feed like that. I know some people mentioned XCM. It did not close for them, but I will mention one thing. Yeah, because it definitely looks weaker from what I'm seeing here. But I will mention something. If I see price have a close call here, or for whatever reason doesn't candle close, but it comes back down and comes back up again, to me, this is a good enough break. Um, for the sole purpose of we came, but like if it's a liquidity sweep, which is the intention of this candle close rule, is the idea that price is going to grab this high and then start very quickly rejecting to grab liquidity at the lows. If I see price grab that high, but we're still stalling in the general area, even breaking above that high again, I understand not only are we leaving equal highs behind here, but it's the idea of it being a liquidity sweep has almost gone out the window comparative to when you see something like this, where even though we did candle close above this high, you can see how aggressively the fair value gap that was formed here, we broke right back down to then grab liquidity at the lows. That's a very clear and impulsive liquidity sweep compared to what I'm seeing here, just this kind of consolidation that comes above this high twice, leaves the equals. It's more than fine to take. Even if I did see this data feed, I would have still been in this position. Um, so yeah, I have that one running at the moment, and then I have AUD/USD, which kind of has not been doing much to be honest. But for me, this is just leaving some general liquidity behind for price to hopefully come through, grab that liquidity, and in the process of doing so, have entry and run. So that's another setup I'm looking at. Do you guys have any setups that you guys are looking at specifically? Let me look in trading chat. What website would I recommend for investing? Sorry, I missed that. So let me send a picture actually from our, or actually you guys are, I'm sharing screen. So in our not investing, this investing section, I have an image in here for brokerages. So in the US, these are my recommended brokerages. Canada, Esteban, if you don't mind sharing too what brokerage you have in Canada, I'm kind of curious. And then Trading 212 is a good recommendation, I think. I've heard odd things about DeGiro. I forget which one Sven is with. I want to say Sven is with eToro, maybe. Um, but yes, or maybe he used to be and switched. I forget what it is. And then Australia, we have these options here. So for me personally, I'm with Fidelity. Um, I think in general, Fidelity and Vanguard, there's no need to start diving into some of these ones down here. Personally, I'm not a fan of any of these ones because they are not federally insured. At least I don't know. I'm not going to speak on Robinhood. I don't necessarily know, but I know Fidelity is federally insured up to 1.25 million in your account, and Vanguard as well. So it is an advantage there where if the company goes under, so let's say Fidelity explodes and the world's ending, I'll still get my up to 1.25 million of my portfolio refunded to me. Um, yeah. So VOO, capsule, VOO, VTI, which is a tech one, VGI, and then QQQ. So these are the QQQ, yeah, so that is it tracks the NAS 100. So it's sorry, VGT, thank you for that. Yeah, so QQQ tracks the NAS 100. So that is definitely the more aggressive one out of these ones here. The least aggressive is going to be VTI, but VOO, VGT, both fantastic. VGT is more tech focused as well, so a little bit more aggressive than VOO. But they're all great funds overall. And then I want to make sure I'm in USD JPY short. I use Wealth Simple. Okay. And USD JPY short. So I would assume if you're in it, you're taking from this high to this low. I do think that's a good trade. My only stipulation here is that it seems to lack the sweep on liquidity or a run on liquidity comparative to what I would actually see is something along the lines of this high here, where we have this consolidation range, and then we have this very impulsive, which, I beat a dead horse using that word, but very impulsive from here to here, an extremely high volume move, followed by another high volume break and taking out these lows. So if you did have some sort of bearish sentiment, I would assume even a trade from this high, I don't think is a bad trade, because I do expect we could probably take some liquidity here. And maybe something along the lines of this and then this on USD Chef. But I think regardless, this is a great trade in general. If it follows your rule sets, -1, +3, whatever it may be, or even a break even, I think it's a solid trade to take. I might even end up looking at taking a trade from this general high. I've not looked at my other pairs yet. I guess you can honestly say a similar thing here with USD Chef based on this general range that we're seeing. A bit of a weaker break below this low here than I would like to see. But, you know, we're working within, I hate that TradingView got rid of, how you can like control and it locks onto the things. You can't do that anymore with the highlight tool, which is pretty annoying to do that all the time. Chef JPY. I don't think I have that one actually. It's a bit of a small minor, but let's see. Forex.com. Okay, my one thing, like right off the bat, what I notice is this consolidation in low volume. I definitely would recommend avoiding over taking something in this range, just because I think the safest option is to kind of see a better sentiment for price. This is it's kind of rough when price is sideways like this. I don't really want to be involved in this general range. I'd like to see, if price were to, for example, break higher, break out of this range, and then, let's say a liquidity sweep occurred here like this, and then broke higher. I think that would be a great example for buys. But overall, I think when price is very low volume and choppy like that, I'd want to avoid it. Um, just because, if I'm not being forced into a position and or no one's forcing me into to take any trades, so I would avoid ones that I don't have to be involved in. Like you could see, I actually did have a Chef J. I think someone mentioned this to me in a webinar a while back. I had this very impulsive liquidity sweep, break a structure up. It was a missing trade. I don't really even trade Chef JPY, to be honest. I don't have it on my watch list. Delete this one. NZD USD, can you check that out? No. Okay, it's definitely aggressive compared to stuff that I take. I don't think it's a bad trade. I would argue a lack of liquidity sweep here or a lack of impulsiveness. That's probably the main thing that stands out to me. It's definitely a small range. It's very aggressive, but if this is something that you're used to taking and testing, um, then I'm sure it could work out. I mean, you're already almost at break even anyways if that's a rule that you use. But yeah, this is not something I'd typically involve myself in. I do risk 2% of my account, so it's a little bit more aggressive than most of you may be when it comes to risk allocation and how much money I have on the line. So I don't like to take these smaller, tiny ranges. I like to take a little bit more of a passive approach, which with these much larger. I mean, you can see simply from the price scale when I go from this image here to NZD USD, the size difference in comparison. Like this barely fits half my screen, and then this covers my full screen just based on that size or that scale of price. So I do like to take these larger trades compared to those smaller ranges. I don't think it's a bad trade though. It does show the majority of the rules are met. I would argue the liquidity sweep maybe, but we do have a strong trend, so you might be trend trading, which is fine. Let's see. Yeah, the USD JPY is a continuation move. I think that's fine to take this low here. And yeah, as long as you've tested it, because I will say I do trade a bit more conservative than a lot of people who take continuations or trades like these much more aggressive ranges. Is there any other setups? Which one? This one here. Yeah, I personally wouldn't take it because I would like to see a little bit more of an aggressive one, but I will say, number one, if you do take these types of ranges, you're going to have a lot more trades and be more aggressive, but on the contrary, you're going to see more profit in the longer term. Both of them would have an edge. Um, so I think that's the first thing to understand is if you were to be more conservative like me and maybe take something after a retracement like this, that would have an edge over the long term. Or if you were to take something like this, you would have an edge over the long term in both cases. I just think this type of setup, you're going to have more positions, more losses, but you're going to net higher profit in the long run because you're taking more positions. Um, Versus something that I might take here where I'm a little bit more conservative with it. I have much less trades than I see some of the people backtesting with these aggressive ranges, but overall my win rate tends to be a little bit higher because I'm taking, setups that have all the rules present each time. But overall, the contrary of that is my profit is going to be smaller long term than the people who are taking these aggressive ranges. But I do kind of compensate with that 2% risk, so it's a give and take. Um, you pose issues when you get onto a live funded psychologically. That's, I mean, in general, anybody who gets onto a live funded account is going to have some psychological issues that come into play, especially the more aggressive traders. That's a Sven type of trade. Yeah, I do agree. But yeah, when you get onto a live funded in general, I think psychologically everybody is gonna naturally have their issues that they kind of run into. When it comes to taking more trades, I think one of the main things I've seen is I get asked about risk allocation on funded accounts. I think personally it's laid out for you, which I think is why it's kind of looked at incorrectly. You're straight up told do not go below 10% drawdown and do not go below 5% drawdown in a day. That to me, there's your risk allocation right there. If you have five setups with 1% risk each, I don't think you should be taking all five. I think limit to four if you have to, or the other option is drop your risk. If you're taking all five setups and you have 1% risk on each, you're just asking to get the account blown based on having too much margin available. Like you're, one solid news move or an incorrect bias in the markets on higher time frame, you could get swept out of 5% and your challenge is gone. So I think from a risk perspective, being a bit more conservative, I guess, with a funded challenge is a better option. But on the contrary, yeah, 1% per trade, two trades a week, I think is fantastic, Joshy. But the other thing I know people have talked about is when to risk more on a funded challenge, and I think that also circles back to for people. So a lot of you might know I used to be funded with MFF, that shit firm. It was great at the time, but they ended up getting caught for doing tampering with accounts and whatnot. Um, but when I used to trade for them, the more challenges, as I got more comfortable in funded accounts, was kind of reinvesting the money that I would make from payouts back into buying more accounts. As I was taking more valuations, I would risk 2%, or actually, I went from 1% to risking 1.5% to then risking 2%, kind of slowly increasing my risk as I less feared the challenge. Number one, less fear in evaluations, leading to better trading, more comfortable trading. Number two, though, was just understanding the probabilities of evaluations in general. There's more than likely a chance that I can lose an evaluation with five losses in a row. Five losses is a typical losing streak. It can happen very common. So risking 2%, it is very possible I could just lose five in a row. But I understood on the contrary, two solid winning trades is enough for me to go and get funded into that live account quicker. I do think it circles back to how much risk is on the table for you. If it's your first challenge ever or evaluation with the firm and you really are trying to get funded, I think 1%, 1.5% is a safe area to be in. But the other thing I will say, if a challenge is taking you 2 months, 3 months, which I've seen before from a lot of new traders who are just so scared to lose the evaluation, you might pay $150 for this evaluation, but for some reason, people, I think it's an ego thing. Traders are afraid to lose that first evaluation because they don't want that feeling of losing it. Obviously, your $150 doesn't even matter at that point that you paid for the challenge. 3 months of struggling up and down and your equity curve is sideways. To me, it proves you're not ready for the funded account on live anyways, and you should go back to the drawing board and practice a little more. Don't want to know how many evaluations I failed compared to past. Yeah, I failed probably failed like my first like 8, 10. I don't even know. Failed a lot in my early stages of funding, but it was mostly just because lack of understanding probabilities is really what it came down to. The lack of understanding that taking the risk to get to the funded account is more important, and then if you want to drop your risk while unfunded is perfectly fine. Yeah, exactly. 0.5% risk on live accounts. I think that's a great, gives you plenty of loss barrier there with your 10% drawdown rule or whatever it may be. I don't know about any of these new firms, what their rules are and stuff, but yeah, I think 0.5% is more than reasonable, especially as you can scale up to larger accounts. And then if you would like, if you're getting payouts with that, you go and reinvest that into 2% risk on evaluations to try and just get to that funded capital quicker. I personally think that's one of the better ways to do it. If it's your very first challenge or two, I think risking 1% and trying to take that slow crawl there is good, but to an extent. If it's taking 2 months, call it quits, go back to the drawing board, practice a little more, practice on demo even if you want. Just don't let it become some long, grueling process of like just mental struggle every day. You're going to burn yourself out, and psychologically, it's not good for any trader. Let's see here. I'm gonna go through some more of my pairs here. Maybe do some higher time frame analysis too after, just because I enjoy higher time frames and just kind of viewing where I'm at in price. Yeah, this is horrendous. Please don't touch price that ever looks like this. I do see that in backtesting sometimes where people are like, oh, sweep a liquidity, break a structure. Let me take this trade because, and the worst part about that is actually the fact that that trade is essentially working out and it's almost, nearing TP. And then when it hits TP, people are beating themselves up like they missed it. Do not let hindsight and how a trade played out affect what you take. This is still a disgusting trade, still a low probability trade. Of course, the low probability ones can win over time, but I see this very often where people will have these very ugly low probability setups and they show it to me in hindsight though, and they'll say, well, this trade won and I missed it. It's not necessarily the case. If you show me this trade before it happened, I would tell you to not touch that dog shit. But Jay, what's your thoughts on gold? I'll check that out in a second. But yeah, I would tell you not to touch this on live, regardless of what happened here and if it goes to TP now. Because I think that's another psychological issue that a lot of people have is they essentially backtrack, they look at what happened with the trade and then go and dive into why they should have taken it. Should be the opposite. If you know beforehand, yes or no, based on your mechanical rules, whatever happens after that should not matter. So let's take a look at gold. Higher time frame, or I've been bullish on gold forever. Yeah, this is I did a markup on gold ages ago. I don't know if you remember Tommy from SMA. Yeah, so I had this, it was in this general area, and then I had the liquidity that was resting here. So my expectation was a slow draw to that liquidity, and then, we had a demand zone. I think it was like a weekly demand right in the side of this area and this FVG, or well, this basically this heavy down push here. So we drew through that liquidity, then to all-time highs. And honestly, ever since then, ever since this point here, I've been very, very bullish on gold, similar to my silver markup that I kind of went over last week, which was in the same exact kind of area around the same time, and very bullish on both since. So I don't see, there obviously can be some retracements that occur, but realistically speaking, I don't see any reason for gold to slow down or retrace too significantly. I'm kind of similar with SPY as well. We've just been so significantly bullish on a lot of these that I'm not the type to try and expect the retracement. Just follow your flow of trend and let it be. Like this is a good example actually. This here was the so-called crash of 2024 when actually it's more specifically from this candle here and we gapped down over the weekend, been overnight. No, it was the weekend, Tuesday. Oh, that's why I'm on a 3-day time frame. I was confused for a second. Yeah, so from Thursday here to Monday. So kind of did that significant gap over the weekend, and people called it a market crash, as opposed to people who just sit there, relax a little bit, don't watch too much of the media. You just realize we're very, very bullish. There's some internal liquidity here. We very intentionally grabbed that point of liquidity. I talk about it all the time when you have significant highs and lows in the market like this. A lot of stop losses rest below there because a lot of investors say price will never reach below this low because we're so heavily bullish. They set their stop losses there. A lot of institutions do that as well, where they set their stop losses at significant highs and lows. as they might trail price. So a lot of capital rests here, a lot of sell positions or sell stops. Um, so price can run through it and convert those orders into that buy power, which is why, the impulsivity is like one of the clearest things to see here. When you see price very impulsively grab a low like this and have an extremely heavy rebound, it's so clear the institutional involvement um, that was present there. You see the same exact thing with the pandemic and the flash crash, as they called it. It was one of the heaviest and steepest crashes we've had within a short period of time, but the rebound on it was absolutely immense. I think it was 430 something percent returns within this rebound, simply because, the institutions are clearly targeting a significant low in price. Once again, like I talked about, converting those orders, and now there's enough liquidity in the markets to drive price much, much higher. And they do the same kind of thing here when we had this, not shorter term, it was much longer term crash in the markets. But what ends up happening is all of this leads to a lot of sell pressure in the market. So from this period of time to this period of time, many, many people are stocking up on sell orders because, the world is ending, the market's crashing. It's all over the media. Sell your 401ks, get out of the markets. Biden, Trump, whoever the hell's in office is, burning shit to the ground. Whatever the media says, it stocks up so much sell liquidity in the markets. All these institutions are doing is letting the sell liquidity come in, and now they can take their buy orders and fulfill them properly to then go and drive price once again to one of the most significant upruns in history. And you can see a similar idea here even on a lower time frame where we have a significant low that's put in place, price starts to rally, and then price comes right back down, grabs that significant low, and now institutionally there's enough buy orders in the market sell orders and sell liquidity in the market present to then convert that into heavy buy positions and just drive price where they need to go. So it's very common. You'll see that same exact trend happen over and over and over in the markets. It's essentially all we look for too on our lower time frame trading is just that clear run of liquidity, clear institutional involvement, and then see price break structure. Obviously, in this case, from this low to this high, it might have been a miss. That's very common with equities, I find, because they don't typically retrace too deep. But on something like Forex, you would see a tap in here before the up run. So it's very similar to the trading plan we have. It's all just rooted in that very basic fundamentals of price, liquidity, volume, and structure. Do you just constantly dollar cost average into your ETFs? Do you try and wait for better entries? I've done honestly both. I don't mostly dollar cost averaging. I would say I have auto investments just set. But one of my greatest, so I like, for example, this year I didn't snipe this or anything like that. I just kind of DCA into it. But one of my most favorable catches is I had this high to this low after the flash crash. Um, and I don't take the 75% of ranges on equities like I just talked about because they don't typically retrace that deep. So all I did was I said, all right, I'll take a buy position at the 50% or the discount or premium of the range. And as some of you know who are my older students, I mentioned even from, I think I called the market crash out somewhere around January, February. So right in this general circle that I have to some students, I mentioned that a possible market crash was coming. And from that point, I just saved my capital up until I basically set a pending order at the 50%. And this was one of my, you know, greatest investments because it hit right in that 50%, triggered on my brokerage. And, I got to run away with the lowest point. So I actually managed to get into this entire up run from physically the lowest point possible here, which was honestly a great catch. One of the greatest dollar cost averages I've done, simply from just kind of trusting analysis a little bit. But at the same time, too, obviously, as it was going down, I made investments along the way at varying price. But I did have a large deposit that was just sitting at that 50% on a limit, which ended up working out really well. If I missed it, I missed it, and I could just continue to dollar cost average in, but it did hit very, very nicely. So that was something with SPY that, at the time being the majority of my portfolio too, was a really, really great catch. But I don't necessarily use that very often. Like, I'm not kind of sitting here on these tiny ranges and just trying to snipe price again. I just like the dollar cost average at this point. Where can you drop some more of those gold, silver, SPY long term pictures? Honestly, like I would. Like I said, I showed you guys the before and after of this one last week's webinar, but at the end of the day, like when I look at these pairs, I'm just so bullish on them. There's not much to even analyze necessarily. Um, now that we took this all-time target, so Bitcoin, for example, I even mentioned that once this all-time high was taken, we can expect some form of retracement from a liquidity standpoint. I don't study fundamentals of Bitcoin. I don't really know anything about it, but all I know is I took 75% profits at the all-time high, and I entered at the 20K level down here. So I did make, good profit on that, but overall, like I couldn't tell you if price is going to drop down here. I don't have a crystal ball. If price is going to continue running higher, I really don't go too in depth when it comes to stuff like that. I just kind of had the understanding of liquidity that, like I talked about with the SPY examples, a significant amount of orders and stop losses rest above this high. So once that area is breached, we can expect some form of retracement. And obviously, it's not showing much signs of liquidity here, but we can see a general area of retracement compared to this massive up run that, this is one of the issues as well with the markets is you got to think of it as a constant, battle between buy and sell side liquidity. And what the masses are doing is creating liquidity for the institutions to absorb. So you got to keep in mind when Bitcoin was getting this crazy hype on this very last up run here, and people are buying in at all these levels, momentum almost died instantly, and it kind of kills off that momentum. Hype goes down. It's just kind of a constant cycle with crypto. Um, Same kind of idea here when price was dropping heavily, getting a bunch of people to sell their Bitcoin and creates a lot of sell side liquidity in the market. So let's just say $100 million worth of people are selling their Bitcoin because of the fear of this crash that's going on. That leaves $100 million for whales who are involved in this market to then buy heavily and absorb that liquidity. So it works institutionally, it works with, crypto whales, whatever it may be. It's just a simple exchange of one buy order to one sell order in every market that kind of creates what we're seeing as price action. But yeah, realistically, I don't have long-term views on most. Like, if you want to see some long-term gold analysis, it would probably look something like this. Like, I don't have much data to work with here. So it essentially, I'm just very, very bullish on these pairs. I don't see much to really work with to the left. So from a liquidity standpoint, we may see some type of consolidation areas, and then up runs to kind of create that artificial liquidity. But otherwise, there's not much going on with those pairs that I can really analyze. Same kind of goes for my higher time frames with some of these other pairs. So um, EU, for example, was one where ages and ages ago, I have the break of structure that occurred here. I have this range that we're working within. I've had this markup on my charts for, it could be a century now. I'll show you even, for example, we have this leg of price down, and then we have a significant break of structure to the upside. Gotta shoot, yeah. See it, Tommy. But I had this break of structure to the upside, same kind of idea that we do with our trading plan. It's the same exact thing. We have break of structure. We have a run on general liquidity within this range period. And we're talking a yearly time frame here at least. I go to the year. How do I go to the 1 year time frame? I've never 12 months, I'm assuming. There we go. So same kind of idea. If you look at this from the perspective and just put yourself in the shoes of our 4-hour strategy that we use, it's almost the same exact thing where we have our fair value gaps. We have our, you can't really see much of past price here, but we have the breaks of structure. We have the range that we're working within from this high to this low to now this high. You could slap your 75% fib on there. It's a close miss, but it does run to TP. And we have the same exact scenario occurring here where we have this low, this high. We have the fair value gap. I'll just mark this one to make it easier and cover less of my screen. So we have this lower fair value gap. We have a break of structure of the highs once again. And then you just toss on your 75 fib from the low to the high, like so. So you can actually see we did get a tap into there on Euro USD. And in about 20 years, I'll hit you guys up and, we could talk about if this hits TP or not. But just a general idea I want to, get across to you guys is the fractal nature of these markets. This is a yearly time frame where we're seeing what I would consider a picture perfect setup. If I saw this in the 4-hour, I'm all over that. has all the rules met really nicely. And yeah, so my expectation for EU on a longer term perspective is very, very bullish. Not to mention we just filled the fair value gap. We just hit that general 75% level, which shows we're in a good discount of price. And then we're kind of working within this general range. So I would be very bullish on EU lately, which then if we dive into these lower time frames, um, actually is one of the important reasons for why I think bias can change the view of the markets is if you were just looking at this time frame, you might see a break of structure here and be bearish on price action. However, understanding the much, much higher time frame and the fractal nature of it, this is what's actually called a Wyckoff accumulation, which means a lot of orders, as we talked about plenty times before, rest below significant lows in the market like this. Think of this as a pool of capital, a pool of sell orders, and when that pool of sell orders is breached, it allows for very heavy buy positions to start entering the market because there's now enough liquidity. And you can see we even have a fair value gap on a monthly time frame, which is enormous. A fair value gap this large on a monthly time frame is a significant amount of capital poured into this market. Hundreds of trillions of dollars when we're talking something like Euro USD. Governments, large scale institutions. There's no other people that can create volume like that on a monthly time frame, especially not you and I investing our accounts fully, liquidating them into there. It's not going to move this chart at all. So does kind of show you the importance of bias in some cases where now I expect this to be liquidity and I do expect price to eventually make its run up towards those highs over the course of many, many years. But then when you do dive into a lower time frame, it kind of helps me build a perspective I've had lately, which is, let me get rid of this off my screen. Working within this general range, it's very, very ugly. Let me go to 3-day maybe. So we are ranging pretty heavily, and it's been tough to form an overall bias on EU. But knowing that higher time frame bias of bullish price, I can set my targets at these highs here, and I can understand that what happened here is a significant low in the market was formed. Even this is a significant low in the market, and even this one is an internal low. And when these lows are taken, like we've talked about before, this is a very overall low. When those are taken and we see price heavily rally to the upside, we're just seeing that conversion of liquidity once again. All the sell orders that rest below here are now converted into buy positions, and we're going to see price start working its way towards highs. And you're seeing the same type of situation happen here. And, our goal is just kind of follow that price action up towards the new all-time highs. Or, sorry, not all-time highs, but the new range highs that we have set here. And so, EU for me personally, we can see a retracement like this. You guys even saw the EU buy position that I took this week from this general area, which was a loss. But following that general idea of very bullish price action, I think it was a great position to take. It actually looked very, very nice too. Some people pointed out the equal lows. I didn't necessarily care about them. But overall, I guess my expectation on EU would be some form of retracement and then more likely than not a run for bullish price. For those of you that have a sell position here at this high and generally entering in this area, I also think that's perfectly fine for the sole reason of some form of retracement into here to then continue lower before going higher. That's perfectly reasonable as well. So yeah, that's kind of just my overall higher time frame view on EU at the moment. I didn't realize it was 10:59. Is there any questions that you guys might have for me before, I try to wrap it up here? I know we talked a lot about portfolios and stuff in the beginning, and we had some people trickle in after that. If you guys want to rewatch it, I talk a lot about, just some basic funds for an investment portfolio, which I think is pretty good because some people are just scared to start investing or scared to admit that they haven't started investing. So if you want to silently watch that video, start with a nice brokerage, get yourself going with $100, $50 in an investment account and split it between those four like I talked about. A start is better than no start at all for those of you that might not have an investment account yet. And obviously, my DMs are open too. I can help out whenever. So if you message me, I can kind of point you towards a good brokerage depending on where you live. And then we can kind of figure out, from there how to actually invest into the ETFs and just kind of set and forget your money. But that should be all for this week. So don't see any questions, so I might wrap it up here. And I'll catch you guys all next week. And the recording should be posted within the next 15 minutes or so. So I'll see you guys. Have a good one.